Just your sense that we now have, I guess, more clarity on Evergrande, and it seems like the market might be turning onshore in China. Where do you think we go there?
Yeah, it's been interesting watching this all play out, and it certainly seems like the takeaway now is that China's more in the focus of managing this sort of issue as it unfolds rather than stepping in to save the day. And certainly we know that that's the new game plan, but we don't necessarily know yet exactly how it's going to play out. But we did get some hints so far earlier this week through the RRR cut, and then now also through what we're seeing so far today with the yuan, looking for a little bit to curb some of the strength that we've seen so far this year. On net, we've been watching seeing through the macro indicators that China having that additional policy support would be warranted to try and facilitate that sort of soft landing. But either way, the reality is that China's looking to have that slower growth going forward in exchange for more quality growth. And that clearly is what's underlying all of these recent moves.
So given just the momentum we're seeing back in China equities right now, you're saying that there's no sign of a catch-up that we could be seeing here? And there's still quite a bit of hurdles that we have to look at and still a lot of uncertainty when it comes to the regulatory side.
Yeah, so there are still a lot of issues to watch. And definitely as international investors, that's always one of the things that we need to pay attention to. And particularly the regulatory risk has been hard to quantify. And that makes it difficult. On the positive side, there has been a bullish case to be made in Chinese equities for a while. At the start of this year, we were really looking to the region as a sort of bright spot in the EM complex. Now a little bit more on the sidelines, seeing how things sort of play out going forward, although certainly these new moves are a sign that maybe some additional easing is ahead and the worst might be behind us.
We've got this key economic meeting taking place, and the narrative is essentially that next year we move towards the whole move from the regulatory stuff into policies which are supportive of growth. What's your take on that?
Yeah, this has also been a long time in the making, just in terms of moving more towards a consumption-based economy that's less reliant on external forces. We know that this has been in the works for years, and also that it became more of a pressing issue during the US-China trade war, when China really realized that going forward in terms of planning, that the focus was going to need to be different. And really what we have seen through the yuan flows was talked about at the start of the hour. A lot of that has been driven by the trade data, which has been particularly strong, and also by external investments. So it'll be interesting to see how the currency is looked at going forward as sort of a policy tool, rather than just as another part of the sort of exports equation.
Looking to next year now, Emily, and you're talking three I's. We just addressed one of them, inflation. The other one's inertia, and then idiosyncrasies. What are you on about?
Yeah, inflation really has been the topic of the year, and it's going to continue in 2022. And really forecasting inflation has been a humbling endeavor for us and for the Fed. Really seeing how these things evolve has been particularly difficult, given the supply chain issues, and also, as was mentioned, the wages that are now following through, and even rent prices now starting to become a bit stickier. Now, the important factor here for us is just that still transitory. We haven't quite given up on that word yet to the same extent that the Fed has. But in our view, transitory relates to price pressures that really aren't quite within the control of the Fed. And so when we look at these sorts of things, rate hike help some of these supply chain issues, and it certainly won't cause help for droughts in different parts of the world, or won't even really relate to different parts of the supply chain glut. What it will do is help to slow the economy going forward and reduce some of that demand side of the equation. So it is a really fine balance to walk, as was said, and the Fed has certainly indicated that now their base case going forward is going to be towards managing inflation, but potentially that could come at the expense of growth, depending on how quickly these issues resolve.
Does it come at the expense of the U.S. equity bull market?
That's a big question. So certainly rate hikes and bull markets don't tend to go well together. The positive news this time around is that so far we still have a decent runway, but before we get to those rate hike momentum and that process sort of kicking off. So far, we think that the taper process is really just a natural sort of conclusion to the end of this extraordinary sort of additional accommodation the Fed provided during emergency measures in the depth of the COVID-19 pandemic. Those sorts of measures aren't really needed as much anymore. So we understand why the Fed is tapering and why they might even decide to speed up tapering going forward, depending on how the data evolves. But really the rate hikes and how much more can be priced in for the next year will be what to watch. It still remains to be seen how quickly the Fed will need to hike, and really whether they're going to need to be as proactive as they think, or whether some of these issues might just sort of evolve naturally and as inflation starts to trend lower, if we do get a little bit of a resolve to these sort of COVID-related issues.
And so what does that mean for EM? I know it looks like it's spelling out to be a pretty troubled, choppy few months, it seems. When do you think that carry trade is going to come back, and how do you express that?
Yes, as an EM analyst, it's definitely not the most encouraging time to be looking at EM assets. And it's been a difficult ride this year, where I think a lot of folks came into the year hoping that this was going to be a better year for emerging markets, given the whole reflation trade story. And that really hasn't panned out as expected at all. And now as we head into this year, the hurdles really seem to be higher. The combination of whether it's Omicron tends to be more difficult than we expect, or even if just Delta and regular COVID pandemic related issues continue, that's going to continue to weigh on the growth outlook. While on top of that, the Fed pivot always puts sort of that pressure on emerging markets as investors reallocate flows alongside the changing interest rates. Now, one thing that we are watching going forward is more of a stock picking selection within EM, looking for currencies that might offer a little bit more optimistic of an outlook in the likes of India and Indonesia, and maybe staying away from some of the other Latin American currencies that are dealing with this growth slowdown and really high inflation.